Hey, it's Lorne Andrews here for Dominion Lending Center's Expert Financial OptimalFinance.ca. So we see rates are on the rise, and we know that there could be potential changes to what's called the stress test. Okay, so what is a stress test? Well, back in 2016, the Canadian government put into place what's called a stress test factor, which allowed you to qualify for a mortgage, but based not on the rate that you're getting, but on a higher rate that would be used in the calculation of your debt ratios. This was put as a safeguard in case rates were to go up, to make sure that within the guidelines you still qualify for that particular mortgage. Up to this particular point, it really hasn't been a factor. However, now when rates are now actually starting to creep up, people, especially those that are on a variable rate, are seeing rate increases. And one of the things, or the stresses that seems to be coming into play, is that many of us are used to paying lower payments, okay? Because even though we might qualify at a higher rate, okay, and right now, as of today, July the 6th, I think it is right now, the stress test is 5.25%, okay? So basically, we were qualifying at 5.25% previous, but we were just paying much lower, especially for on a variable. Basically, what happens now, if I come into a home, and the rule is a stress test is your 5.25% or the rate that you're going to be given plus 2%, whichever is greater. Okay, so let's say, for example, I am actually going to want a 5-year fixed mortgage. And so let's say the 5-year fixed right now is about 5.09%, let's say, for example, for a high ratio 5-year fixed mortgage. I actually have to qualify now at 7.09%. So what does this do for me in terms of how I would qualify? So a couple of things is, so if I walk into the bank and say, hey, this is how much I qualify, they'll get you pre-approved at a 5-year fixed rate. It might be a little bit different than the amount that I would get if I was actually trying to qualify at a variable rate, just because of where interest rates are going right now. So for example, let's take a couple that makes $150,000 a year, and let's assume they don't have any other debt. Just assume this is the amount, and they're going to be putting less than 20% down. So these are insured mortgages. The mortgages with the maximum amortization, or the maximum amount of time that you can take to pay that mortgage, is 25 years. So let's say, for example, this particular couple, $150,000 combined income, they qualify for a mortgage at the stress test at 5.25% of about $680,000. But if they chose to go to a 5-year fixed term, okay, we have to qualify them at 2 points above whatever that rate is. So now we're qualifying at 7.09%. And again, that's not the rate that they're going to be getting. It is going to be the rate we need to qualify them at. That changes their approval for a mortgage amount from $680,000 to $590,000. Okay, so that's significant. That's like $90,000 difference between what they're going to be qualifying under those two amounts. Okay, so a couple other factors here. What happens when rates are going to be going up? Are they going to be changing the stress test? Well, right now it is a factor of whatever the rate is plus 2%. The only time we're really using the minimum stress test is when you're in a variable, but they're anticipating on July 10th, there might be a 0.75% rate increase in the variable rate. So that could potentially actually increase the minimum stress test that we would use. Fair rate of assumption is that every 0.5% that the stress test increases will lower what you qualify for by about $20,000 based on $150,000 combined income. So there might be a little bit more factors that's diminishing over increased amount of income. So, but the rule of thumb is just it's about every 0.5% increased step in the qualifying rate will decrease what you qualify for about $20,000. So here we are in a strange market. We have inflation going up, we have rates going up, and we have a lot of inventory in the market. So I see a lot of buyers out there thinking, I'm just going to wait because maybe I can save an extra $50,000, $100,000, whatever it is, as they feel that prices are going to be normal or going to normalize because of the inventory and the choices out there. Well, there could be a problem with that, because if the rates do start to increase, okay, and even though you would qualify in terms of how affordability, if the stress test reaches certain peaks, okay, it could actually, that house that might have decreased by, say, $50,000, that you qualified for today, tomorrow you may not qualify if the stress test increases and all of a sudden it's decreasing your purchasing power. Okay, so it's something to be aware of, and that's is why it's really, really important to say, okay, let's start making some planning now. Reach out to your mortgage broker and consultant just to come up with that plan, okay, to make sure that you understand the numbers and what it means to you. The second part is you might qualify for a more of a mortgage if you remain in a variable. However, you have to also understand that will increase too, potentially with rate increases. And it will decrease with rate decreases as well. But you have to be comfortable with that, okay? Because if you're not sleeping at night and because you think that rates are going to keep going up, and I'm a big fan of the variable because there's a lot of other factors in this that you've seen in my other videos. I talk about penalties if you're into a 5-year fixed and everything else, especially with the larger banks. Those things are huge factors, right? So you want to make sure that whatever you're going to be deciding in terms of the strategy, it's, hey, what is your short-term goals? What are your long-term goals? Where do you want to see yourself? And if you want to make sure that you have a comfort level, what is the strategy to do that? Okay, so just make sure that, whatever planning that we're doing together, we're making sure that we have, we consider so many other options in terms of not just your mortgage options, but we just really need to have a clear definition of what your goals are as well. Okay, so because ultimately when we do financing on our side, this is the biggest debt you're going to ever have. Okay, and I believe it's our responsibility to help you manage that debt throughout the life of the particular mortgage. So I know with our relationships, they don't end when you get a mortgage. It continues on because I need to make sure that throughout this journey you get financial peace of mind, and this is what we work towards. Okay, so very, very important. So another question I see, Lorne, does stress tests apply all the time? There's always a stress test. Well, no, not exactly. So if you are putting less than 20% down on a home, it has to be insured. And the three insurers are CMHC, it used to be Genworth, which is now called Sagan, and Canada Guarantee. So these are the insurers that make sure that they allow you to buy a home with less than 20% down. So basically the bank pays this insurance premium on your behalf, they put it into the mortgage, and that's what allows you to buy with less than 20% down. And any of those deals, that 100% stress test always applies. When you're within any type of chartered bank or anything federal, law, the stress test applies. The only time it doesn't apply, is when you're dealing with credit unions, because credit unions, they're governed provincially, so they actually have non-qualifying rates, which are usually higher than normal rates, but you don't have to qualify at the stress test rate. So sometimes that is always an option we look at because we deal with many, many credit unions as well. And again, an advantage of working with a mortgage broker is you're not dealing with just one lender. We have access to so many different lenders and credit unions and everything else. So it's figuring out what's best for you, what the best fit is, and making sure that we fit you exactly where that needs to be. Listen, we're here to help. If you have any questions right now, it is amazing what's happening in the market. I think for buyers, it's a great thing because now, you can put conditions on offers for the most part. I see a lot of them coming in with conditions on financing, home inspection, and whatnot. So it's protecting our buyers a lot more. The sellers is a little bit tougher because there's a lot more competition out there. So when we work with the sellers, how do we make our properties, more attractive and stand out among your competition and everything else? So, real estate is a great market, and particularly, especially within Ontario, it's been always a strong market. And I think that when you see, and everybody says, all these prices are coming down, they're just adjusting is really what it is. You're going to still see, I believe, year over year increase overall, but what we saw over the last couple of years isn't normal. There is going to be an adjustment to that, and just in 2017 something similar happened, not quite like this, but very, very similar. In these times, real estate, great time to look at leveraging real estate to build net worth. Look at buying a home if you're thinking investment properties as well. There's a lot of opportunities out there, and a lot of people are looking at still taking out a lot of equity, like a lot of equity built in their home. Position yourself to get access to that equity when you need it. Okay, hey, any questions, we're here to help. Looking forward to seeing you on our next video.